So glad you're with us on the Money. Allied Wealth, Ryan Wheelis is with me. I'm Brad Johansson. Nice to have you this morning. Always good to be with you, buddy.
Always a pleasure, my friend. Good to see you.
Can we start taxes? Because I think it's the most relevant situation right now. Not that we ever want to talk about taxes, but it is so important at this point because I say we know the rules right now. Now, I say that still dealing with a government that can change them seemingly at any time they want, but we're in probably the third best tax bracket that we've been in U.S. history. People may not be aware of that, and in doing so, wouldn't we want to plan for something while we're in a decent situation?
Absolutely, but here's the thing. A lot of people don't realize what they actually have. And so we have a concept at Allied Wealth that we teach called the composition of your accounts. And so what happens is we're taught to save in tax-deferred modes. We want to put money in IRAs, 401ks, and we go into those accounts, we get a tax deduction. Those dollars, while they're in those accounts grow tax-free, and then later on in life, we pull money out at 100% tax rate, right? Every dollar's taxable.
Yeah.
The idea is that we are now going to be in a situation in the future where when this stuff started, that we'd be in a lower tax rate. So that was okay to kick the can down the road and defer the taxes. But now our country is $34 trillion in debt and climbing. In fact, we're adding $1 trillion in debt every 100 days. And as you said, tax rates are at historic lows, like the third best in history, right? So it doesn't make sense that tax rates are so low and debt is so high. That dog doesn't hunt.
Well, the problem, the reason why the dog doesn't hunt is because there's bullseye on so many backs right now. If you're talking about tax-deferred accounts, and we're talking about 401ks, so you list the 34 trillion. By the time we talk, who knows, it may be another trillion by the time we end up
by the end of the show,
as it continues to grow. The bullseye ends up being if those tax-deferred accounts are holding 38 plus trillion, where's the government going? They're going after tax-deferred accounts. You said something that kind of piqued my interest at the beginning. We try to talk to people because they don't know what they have. What exactly does that mean?
Well, so many people don't realize that every dollar that comes out of these accounts is 100% taxable at ordinary income tax rates. Okay. And that's a big deal because what happens is over time, the money coming out of your accounts is taxed at higher and higher rates. So if tax rates go up, the higher the tax rates go, the less income you have to spend. So the thing about taxes you have to think about is this. The higher taxes you pay, the more income you need out of your portfolio to sustain your lifestyle. The more income you need, the higher rate of return you're going to have to get. All right? The higher rate of return you have to get, the greater to get that return, you have to increase risk in the portfolio, and you subject yourself to a major market crash in a down market just to combat taxes.
Okay. So if we're in a situation where we don't even know what our number is, especially because of what we have partner-wise of where we're going, if I've got this major problem and I've got a bullseye, do you have solutions as to get this bullseye off the back during this fortunate time for us in a tax rate bracket?
Well, there's plenty of things that we can do, and we've got two ways to do it. You can do reactive tax planning, which is the government's plan. Just let it happen, all right? You could do proactive tax planning, where you seek to take the amount of money out of Uncle Sam's hands and keep it in your hands, legally, of course, right? And there's plenty of ways to do that. So one of the things that you can do is look at your income tax brackets now, all right? And let's say that you're in the 12% bracket as it sits today. Well, one thing you could do is start doing these things called Roth IRA conversions, where you're taking money out of your IRAs, moving it over to a Roth IRA at a lower tax rate. You're going to pay tax on that money when you do that. But when you do that, the dollars in those Roth IRAs are never taxed again. So what happens is you've got a tax time bomb in your hands. And so we've got all this money in these tax-deferred accounts, okay? We've got to start taking money out at age 75 for RMDs, earlier in some cases as well, depending on your age, all right? And what happens is that we allow these accounts to grow and get very, very big, all right? These RMDs that we're going to have to take later in life get very, very large. And we're forced to pay taxes on large amounts of money.
Well, and the government did this in moving the numbers back, 70, 73, 75, because that compounds and the government gets more of your money in the taxing by letting it wait.
Absolutely.
As you said,
they get
kicking the
more,
can.
there's more growth for them to tax in the future. And here's the other thing, too, Brad, that's really, really interesting is when a spouse dies, the surviving spouse has 1 year left to file as a joint filer. They have to move from the joint filer bracket to a single filer. In that case, they've lost a Social Security check. But not only that, but the taxes they're going to pay are going to increase by almost 50%. Jeez. So you can have a massive haircut. And then to make the problem even worse, all right, they did this thing called the Secure Act, which is setting up Americans for Taxation Act, by the way.
Yeah.
All right. And so what happens is now when your kids inherit IRA money, they've got 10 years to take the money out over a 10-year period. Well, most of us probably worked hard, put our kids through school, did without, and our kids are coming out of school, and they're becoming engineers, they're becoming lawyers, doctors, and having a good income. And now all of a sudden, mom and dad die, all right, and these IRA distributions are piled on top of their income. And now what happens is 35 to 40% of mom and dad's IRA money is gone.
And likely they're ignorant as to what the rules are over the next 10 years.
And the rules can change.
And the rules can change. I mean, if we're talking about 30 years in retirement, we're talking about 15 different congressional elections where they can change the rules at that point. We always talk about tax filing, which irritates people. The problem is what you're saying is most people aren't tax planning.
That's right.
At this point, which is a completely different thing.
Well, a lot of people rely on their CPA to do it.
Yeah.
All right. And CPAs are reactive in nature in the sense that they record a moment in history on a tax return. They're not proactive. CPAs often don't give you tax planning advice in the sense of doing Roth conversions and reducing the amount of money you have in IRA accounts and 401k accounts that we call tax-infested retirement accounts, by the way.
Tax-infested is exactly the term that fits with this. If there's a best way to do it, you're asking people to come into the office maybe to find a tax map at this point.
Well, a tax map, but more importantly, what we want to do is show you, okay, here is what your tax bill will be if you use the government's plan. And here is what your tax bill would be and the savings it would be if you take a proactive approach to tax planning. And the mind-boggling difference and the light bulb that comes on in people's minds is absolutely incredible. And Brad, we've got ways to have where a program to where we can get bonuses on programs out there that actually help mitigate and pay the taxes on these Roth IRA conversions for you. Pretty cool stuff.
Do you even know about any of this? Have you gone through a tax map? I know you've filed taxes, but have you planned your taxes? Now's the time. You know the rules, and you know the rules are going to change. Let us help you. Put it in a full retirement plan with a tax map. Call the number on your screen. Let's do it for you now. We'll be right back.